And from consumer prices to the markets, John Terrett has a look at how the markets closed out at the NYSE.
Tuesday's session on Wall Street was dominated by what happened early in the morning, about 8:30 local time, when the latest CPI number came out, the Consumer Price Index. In other words, inflation paid by Americans at the stores and the gas stations. Now, as you know, it's been at a 40-year high, and the Fed has been raising interest rates to try and bring it down. And they have been successful, because a year ago it was at 9.1%, and now, according to the April figure, it was 4.9. So let me just remind you what happened in May. Really a lot better than people had anticipated. 2-year low, cooler than expected, falling for 11 months in a row. Shelter seems to be the main reason for the elevation, but the headline rate is still at 4%. 4% in May. That's good, but it's still 2% more than the Federal Reserve is looking for. Nonetheless, the Federal Reserve seems to be going down the road of a pause when it makes its decision on Wednesday, and Wall Street certainly believes that. Now, at the same time, there's not much selling going on here. Markets have been drifting up these last couple of days. There is a lack of confidence about what happens next as we go through towards the end of the year, but for the time being, the S&P is out of bear market territory. Here we go. The Dow was up 0.4%, the Nasdaq 0.8%, the S&P 500 0.7%, and Bitcoin up 0.1% at 25,800. On Wednesday, that key Federal Reserve decision comes at 18 hours GMT. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on the state of the U.S. economy and a look ahead on what the Fed might do, I guess, is Ted Rossman, Senior Industry Analyst at Bankrate.com and CreditCards.com. Good to see you again. So here we are. I think this is not a surprise that the CPI is coming down. We've been forewarned on this. I think what is a surprise is the strength and the health of the U.S. economy in the face of, tech layoffs, the banking stuff. And we've had some pretty big speed bumps, but it seems to me that the truck just keeps rolling. So I think this is going to put the Fed in a weird position, because they've got to make a decision on whether or not to pause. And if they don't pause, people are going to say, well, is that a precursor to what's to come? But if they do pause, then they're going to start thinking about, well, they could unpause later. It's kind of a lose-lose.
It's very interesting. I mean, we've been saying for a while now, there are a lot of conflicting signals in the economy. Consumer spending has been remarkably robust. I feel like in recent weeks, the so-called soft landing hypothesis has gained some steam, that, the National Retail Federation and other groups have come out saying that, hey, maybe the Fed can engineer what they're trying to do, which is to bring down inflation without causing a recession. I mean, I think there is still some room for error, and we still need to wait and see. And most importantly, the Fed is going to wait and see. It seems very likely that we'll get a pause at this week's meeting, but could there be a rate hike as soon as next month? I guess time will tell. I think the main theme, though, is that if the Fed's not done raising rates, they have to be close. But I do think that rates will plateau for a while longer. So that will continue to have dampening effects on the housing market, for example, and people with credit card debt. Those rates are
look, I saw the stats on rent. I'm sure you're watching this as well, that rents are not dropping anymore. And home prices are not dropping anymore. And we all thought, oh, rents would come down and home prices would come down. And it did for a little bit, but now we've kind of plateaued. And the health of the consumer has been absolutely remarkable. And you have to think the fact that the jobless rate, I know it's at 3.7, but let's say a number below 4, is tremendous, because the consumer is what's keeping this engine, so to speak, going. And I still think there's some revenge travel. And you look at hotel rooms and airplane flights, everything is 50% or 100% more than what it was last year.
For sure, yeah. It surprises me how robust that travel demand continues to be. People have tailed off on spending on physical goods, things like furniture and electronics and clothes, and a lot of that stuff is not doing as well. But yeah, experiences are really hot. And you're right about the strength of the job market. I feel like that's been a huge contributor to the fact that the economy is hanging in there. I mean, really more than hanging in there, I would say. There are winners and losers, though. I mean, we think about the fact that credit card rates are about 5 percentage points higher than they were a little over a year ago. The housing market, there's a feeling that when it comes to rent increases, we're going to start to lap those big increases from a year ago, and that there's kind of a lag there because your rent may only reset once a year. There's a feeling that if rates were to fall, we might see some more activity in the buying market, because that is still a headwind for buyers. The fact that not only are prices up, but rates are too. I mean, we're pushing up against 7% for the 30-year fix. That's cut about 30% off of home affordability. But even there, low inventory is keeping things relatively stable on the price front. It's not like we're seeing big drops or anything like that.
And you compare what is happening here to Asia and Europe, right? Europe already had kind of a recovery bounce. We're still kind of waiting for Asia to some extent when you think about post-COVID. But looking at around the world, the U.S., while not perfect, is performing certainly better than Europe. We have more spending power than apparently when we compare it to Asia. And so even though it's not perfect, it's still the best in the lot. If you had $1 million to throw your money around, maybe that's what's happening, is there are people around the world who are betting on the U.S. despite the issues.
Yup, and we avoided the worst with the debt ceiling, so that's definitely a sigh of relief. And actually, right now, with all the new Treasury issuance, that's actually doing some of the Fed's work for them, kind of pulling some money out of the system and putting them into Treasury securities. I think energy is an interesting theme here as well. The fact that energy prices have come down so much. I mean, clearly that's a tailwind for the American consumer, spending less at the gas pump. That's a big deal for Europe, too. I mean, I know now we're in the summer season, but I feel like the winter heating season was not as bad as it could have been. We think about just all the tumult in energy markets with Russia's invasion of Ukraine, and the fact that policymakers were able to prop up things like the natural gas market. So something to watch for next winter, I think.
Ted, 10 seconds. What's the Fed going to do tomorrow?
They're going to stand pat. They're going to get a lot of questions about what comes next, but I think they'll stress data dependency. But I think we get a pause this week.
All right. Thank you very much. Good analysis there.